Hello there. Welcome to the fascinating world of swing trading. Let's demystify swing trading, a way to profit from the market's natural ups and downs. Unlike day trading, which requires constant attention, or long-term investing, which demands patience over years, swing trading strikes a balance. Picture a pendulum. Swing trading is about catching a profitable part of that swing, not the whole ride. Imagine the market as a giant pendulum swinging back and forth. Swing traders aim to catch the most profitable part of that swing, capitalizing on short-term price movements. You hold a stock for a few days or weeks, aiming to hop on for a solid move, then hop off before it reverses. The idea is to ride the wave of momentum, capturing gains as the stock price moves in your favor, and then stepping off before the tide turns. It's a middle ground, more active than long-term investing, less frantic than day trading. Swing trading offers the best of both worlds, providing the excitement of frequent trades without the need to be glued to your screen all day. Swing trading lets you spot opportunities, use your wits, and still have a life away from the screen. You can analyze charts, identify patterns, and make informed decisions, all while enjoying your hobbies and spending time with loved ones. The goal: find a stock about to move, ride the wave, and exit before it turns. It's about being strategic, knowing when to enter and when to exit, and making the most of each trade. It's about timing, pattern spotting, and a bit of patience. Successful swing traders develop a keen eye for market trends and have the discipline to wait for the right moment to act. With the right approach, it can be a rewarding adventure, almost as satisfying as a good bit of cheese. So, are you ready to dive into the world of swing trading and discover the potential rewards it holds? To understand swing trading, let's compare it to other market approaches. Day traders are sprinters, jumping in and out of trades within minutes, chasing tiny profits all day. Long-term investors are marathoners, buying and holding for years, ignoring short-term bumps. Swing traders? They're the brisk 5-kilometer runners, holding positions for days or weeks, aiming for a sweet spot between action and patience. They look for promising moves, ride them for a bit, then move on. It's about balancing effort and time, without being glued to the screen. You get to participate, make thoughtful decisions, and still have a life. Swing trading is the thinking person's compromise. The swing trader's goal is simple, but it's far from easy. At its core, swing trading is about capitalizing on the natural ebb and flow of the market. Those price movements that happen over days or weeks, not just minutes or months. Unlike day traders glued to their screens all day or long-term investors who hold for years, swing traders live in the middle ground, seeking to profit from the market's rhythm. Their mission? To catch a profit from the market's natural rhythm, riding the waves of price action as they rise and fall. It's a dance with the market, requiring patience, timing, and a keen sense of observation. Stock prices rarely move in straight lines. Instead, they move in waves, uptrends and downtrends, with plenty of twists and turns along the way. These waves are shaped by the collective emotions and decisions of millions of traders and investors, creating patterns that swing traders try to spot and exploit. Swing traders aim to capture one of these waves, not every tiny move. They're not chasing every tick or trying to predict the next market crash or boom. Instead, they look for a clear, strong movement, a trend that's already underway, and jump on board for a portion of the ride. Think of it like fishing. You're not after every minnow in the pond, just a decent catch from a promising spot. You wait for the right moment, cast your line, and hope to reel in a worthwhile prize. Sometimes you catch a big one, sometimes you don't, but you're always looking for that next opportunity. The beauty of swing trading is that you can profit whether the market's going up or down. You might buy on the way up, riding the momentum as prices climb, or you might short on the way down, taking advantage of falling prices. Flexibility is key, and swing traders are always ready to adapt to changing conditions. It's about spotting a clear, strong movement and riding it for a short while, just long enough to capture a meaningful gain before the trend fizzles out or reverses. Timing your entry and exit is crucial, and that's where skill and experience come into play. The focus isn't on finding the next big thing or scalping pennies from every little fluctuation. Instead, swing traders look for setups with the best risk-to-reward ratio, ignoring the noise and waiting for the right moment to strike. Instead, you analyze the current mood of the market, identify a likely swing, and plan to capture that move. This means studying charts, understanding market sentiment, and sometimes even reading the news to get a sense of what's driving prices. It's a puzzle. Find the pattern, ride the swing, and repeat. Each trade is a new challenge, a new opportunity to test your skills and refine your strategy. That's the swing trader's game. Patient, strategic, and always ready to catch the next wave. You can't just guess where swings will happen. You need the right tools. Swing trading is all about timing and precision. Without the right set of tools, you're essentially flying blind in a storm. Imagine trying to navigate a ship without a compass or a map. It's nearly impossible. The same goes for swing trading. You need instruments that can guide you through the volatile waters of the stock market. The price chart is your main instrument, showing how a stock's price moves over time. It's like the heartbeat of the stock, giving you a visual representation of its health and activity. By studying these charts, you can start to see patterns and trends that can inform your trading decisions. Candlestick charts reveal daily price action, green for up, red for down. Each candlestick tells a story of the stock's performance for that day, showing you the opening, closing, high and low prices. This detailed information can help you predict future movements. Patterns emerge in these candles, hinting at market mood and momentum. Recognizing these patterns can give you an edge, allowing you to anticipate potential price movements. For example, a series of green candles might indicate a bullish trend, while a series of red candles could signal a bearish trend. Indicators like moving averages show the trend. If price is above, things look up; below, things look down. Moving averages smooth out price data to help you identify the direction of the trend. They can also act as support or resistance levels, providing you with critical points to make your trading decisions. The RSI tells you if a stock is overbought or oversold, like a pressure gauge. An RSI above 70 suggests that a stock might be overbought and due for a pullback, while an RSI below 30 indicates it might be oversold and due for a bounce. This can help you time your entries and exits more effectively. Think of your chart as the window, moving averages as your compass, and RSI as your warning light. Each tool has its own role, and together they provide a comprehensive view of the market. Just like a pilot relies on multiple instruments to navigate, you should use these tools in tandem to guide your trading decisions. Don't rely on just one tool, combine them for a clearer picture. Using multiple indicators can help confirm your analysis and reduce the risk of false signals. For instance, if both the moving average and RSI indicate a bullish trend, you can be more confident in your decision to buy. These tools help you make educated decisions, not wild guesses. By relying on data and analysis, you can increase your chances of success and minimize your risks. Remember, the goal is to make informed decisions based on solid evidence, not to gamble on hunches. Use technology to your advantage. Modern trading platforms offer a plethora of tools and resources that can help you analyze the market more effectively. From advanced charting software to real-time data feeds, leveraging technology can give you a significant edge in your trading endeavors. With your tools ready, you need a strategy. Support and resistance are key. Think of them as invisible floors and ceilings for price. Buy when price bounces off support, sell near resistance. Or, follow the trend. Buy during small dips in an uptrend, like catching a ball as it lands on a step. Chart patterns like bull flags or head and shoulders can signal big moves. Learn to spot these patterns. They're clues, not guarantees. Keep your strategy simple, especially at first. Don't overload on indicators or patterns. Pick one or two and master them. Test your plan, refine it, and stick to what works. A simple, reliable plan beats a complicated mess. That's the difference between a successful invention and a pile of scrap. The most important part of trading? Managing your risk. Even the best plans can go wrong, so protect yourself. Use a stop loss, an order that sells your stock automatically if it falls to a certain level. Decide your exit plan before you enter a trade. Position sizing matters. Never risk more than a small percentage of your capital on one trade. For example, with £5,000, risk only £50, £100 per trade. This way, a losing streak won't wipe you out. Your first job is to defend your capital, not chase millions. Think of your money as rocket fuel. Don't burn it all at once. Use stop losses and small risks to survive and thrive. It's the cleverest thing you can do. Let's see swing trading in action. Imagine a Grand Loaf Bakery stock bounces between £8, support, and £10, resistance. The price drops near £8 again, and your indicators look promising. You buy at £8 10 pence, aiming to sell near £9 90 pence. You set a stop loss at £7 80 pence to limit your risk. Your potential reward is much bigger than your risk. Over the next 2 weeks, the price climbs as hoped. When it hits £9 90 pence, your broker sells automatically for a tidy profit. You didn't get greedy or panic, you followed your plan. That's a textbook swing trade. Spot the setup, manage risk, stick to your plan. Bank your winnings, then look for the next opportunity. Simple, disciplined, and effective. Ready to try swing trading? Start smart. Educate yourself. Read, watch, and learn about charts, strategies, and risk management. Practice with a demo account before risking real money. Treat it like a flight simulator. Make mistakes with fake money, not your own. Only go live when you're consistently successful in practice. Start small, use money you can afford to lose, and stick to the 1% rule. Focus on learning and survival, not instant riches. Keep a trading journal. Record every trade, your reasons, and the results. Review your journal to spot patterns and mistakes. Are you cutting winners short, moving stop losses? The journal reveals all. Continuous learning and self-review are your best tools. Build a solid foundation and profits will follow. We've toured the world of swing trading. A balanced, engaging way to profit from market swings. It's not as frantic as day trading or as slow as long-term investing. The key is spotting likely moves, using the right tools, and having a solid plan. Most important of all, manage your risk with stop losses and small position sizes. Start with education, practice safely, and always protect your capital. Swing trading takes patience and discipline, but it's a rewarding adventure. Learn the ropes, build your own trading contraption, and enjoy the ride. Now, how about a nice cup of tea and a bit of Wensleydale? Smashing.